Hello, everyone, and welcome to the BBA Show. This is Adam Wyatt, aka AKW Analytics, and as usual, I'm here with Rich. How you doing, Rich? It's been a while.
Yeah, it has been a while, man. But good morning to you. It's good to be here. I'm glad we're back in the swing of things. I know you've been crazy busy over with the Slack team and creating some new products over there, right?
Yeah, man. BBA's got some exciting new stuff. We have kind of another one of these extended consolidations in Bitcoin that unfortunately we're all getting so used to. But that means that there's a lot of action in the altcoin space. So yeah, BBA has created a new product called Altcoin Pro that mainly focuses on kind of the smaller cap, less liquid coins and plays on those. But yeah, it's been really busy around altcoin land these past couple of weeks, that's for sure.
Yeah, it's usually what we see is the volatility from Bitcoin tends to flow into the altcoins when there's a consolidation period in Bitcoin. So it's pretty clear as what's going on. Yeah, exactly. It swings back and forth, which, it makes it fun and interesting and always an opportunity to make some money or lose a lot.
Well, that's what I'm saying. These kind of relationships that are developing, these kind of cycles, where you have a big, let's say it starts with a big Bitcoin pump and then that stops and it starts consolidating, and then the kind of the big cap alts start getting some attention, and then those pump and then they come down, and then the second tier and third tier ones start to rally. And then by the time just the shit coins, the clones and stuff are pumping, we're getting close back to another Bitcoin rally.
Yeah, that's like a full cycle.
Yet, but,
right.
Yeah. Yeah, I don't think we're there yet, but we're close. I mean, I think we'll start to see some of the shit pumpage here in the next, maybe week or so. Which would be a good sign. But yeah, I mean, just real quick on, let's start with Bitcoin, just because, like we said, it's been just really flat. I mean, like at 575, I don't know if I've seen it this stagnant in a year, probably since around this time last summer, just with the summer doldrums and all. But we did have the Bitfinex hack, which has really been the news since the last time we talked.
Right.
The hack itself, of course, those are bad things. That it sucks that happens, but that's just part of the game that we're playing here. But what was more confusing and kind of still kind of odd to me is the whole BFX coin and the debt thing. I mean, if I really went through and looked at it, like an analyst, then I'm sure I could, come to a conclusion about what they're essentially trying to do. And I think what they're trying to do is just get cheap financing to keep themselves afloat. But the whole thing just seems weird and shady and crappy. I don't know. What do you think?
Yeah, it definitely. I don't know what to make of it either. I mean, it's such a strange situation because this is the first occurrence of an exchange essentially bailing themselves out, right? Like, well, they took everyone's money and bailed themselves out, and then in exchange they gave you this like a token that's worth some future value that may or may not ever exist, and it's up to the market to price that in. And obviously we've seen, I think it came out par value $1. It dropped as low as like 25 cents, something like that, which you can kind of look at the way the market prices the BFX coin is, I think, proportional to the market's anticipation of whether or not Bitfinex will survive. Right. Yeah. So obviously, as the price dropped, the survival rate dropped, and then now it seems like the market is starting to creep back up again on its anticipation of Bitfinex's survival. So, we'll see. It's coupled with speculation from traders as well that are looking to pump their way out of a shit deal. try to get out of a shitty deal. But time will tell. Go ahead.
No, I was just gonna just real quick. I'm coming from the legacy background back before I got into crypto, and I was there for a while. The main thing I have a problem with, I don't know if this is debt or equity or what it's supposed to be. It has a par value, but there's no coupon, and it's not equity, but it can be converted into equity one time. So it's like kind of like a preferred offering or something. I don't know. It just seems like it's legally tenuous, and it's kind of a last resort Hail Mary.
Yeah, because it's not exactly like a preferred stock, because preferred stock typically pays dividends, right?
Right. Right. But there's no coupons on these things.
Right. There's no dividend payment. At least not that I'm aware of. No. And then let's see. But it's convertible to ownership sometime in the future,
Maybe. I mean, I think that's what I read. Like they're working with a law firm to be able to allow people to convert these BFX tokens into equity at some point, maybe equity options or warrants or something like that. I don't know. That's just like, well, if you wanted it to be equity, you should have just sold some equity to the private market, right?
Yeah,
but they probably didn't want to do that because then you got to do a private placement, a filing with the SEC and all that. So again, I think they're trying to do the easy way out here.
Well, so then they're IOUs, right? They're not even
right.
Because it's not a debt instrument, because a debt instrument pays interest. Well, we're not getting that, but it's not an ownership interest either, because it's
right.
we don't know for a fact that we have ownership in Bitfinex yet. They're trying to figure that out, whether that's possible down in the future. So it's just an IOU. It's like in Dumb and Dumber when they show up with a suitcase full of IOUs to pay the guy back, and he's like, "Oh, that you know what I mean? Like the Lamborghini. Oh, that's one you want to keep. It's worth $150,000."
Right. Exactly. That's funny. And another thing that's odd is that these coins were like in the free markets, in the debt and equity markets, a company goes to the market with an offering, and then the market says, well, we either want the offer or not, and if we do, here's the price that we're willing to pay for your offering.
Right.
In this case, nobody offered anything. People were had these coins forced on them, and then they're like, oh, okay, well, now what do I do with this crap now? It's not jiving with me. Maybe it works, and it starts this new kind of innovative way of financing a troubled company, but I don't know. I have my doubts.
I have my doubts as well. I mean, it might buy him some time to figure out a better alternative. I think that could be the greater possibility, is that for now it soothes some anxieties in people who had deposits on the exchange, and it's buying them time long enough to figure out a more viable alternative solution.
Yeah.
The problem is, when you do things like this, you draw a ton of attention to yourself from regulators. So I'm really afraid as to what's going to happen. I don't know that Bitfinex is going to be in operation that much longer, at least in the US. If you're a US customer, it may not be able to operate.
That's right. Yeah. You can't even do anything. Like, I don't even know if people in the US are able to sell their BFX coins or whatever. I don't think US customers could do anything.
Yeah, they definitely can't margin trade. I got on the other day. There's no trading on margin. You can trade flat, like you can trade unlevered.
Yeah. Okay. Yeah. Okay.
I don't know of anything else.
But you're right that it will attract the attention of regulators, no doubt, and that that legal costs alone there could be devastating. But that kind of brings us to the main point of what I want to talk about here is just the exchange environment. There's not a ton of places to spot trade Bitcoins now. I mean, it's kind of frustrating, especially for people in our industry who, rely on the exchanges to do what we do, to trade, as facilitators of our profession, essentially.
Yeah.
And so right now, you got Bitstamp. There's not a lot of volume. You got OKCoin and Huobi, but I don't know how many people feel comfortable. How many U.S. people feel comfortable trading on the Chinese exchanges? I don't have a problem with it, but the conversion's a little confusing, and the interfaces aren't that great. They're pretty hard to get used to. And I don't know if people trust them. I trust them more than the U.S. exchanges, to be honest. But and then there's Coinbase, who I'm sketched out about too. So. Yeah, I don't know. At this point, it's kind of discouraging. I'm just hoping that in the next, 3 to 6 months, we see either a new exchange that people are excited about, or something like a BitSquare or some kind of decentralized solution that picks up at least enough steam to just be able to make a couple trades on a platform like that. Now with the spread, you can't even do it, but. That's my hope. Who knows? At this point, I think, unfortunately, keeping the majority of your stash in a safe place away from exchanges is probably optimal. But if I was forced to trade somewhere, I would probably trade at Bitstamp, even though there's no margin.
Yeah, I've been thinking about this too. So, a company like Kraken that's been around a while, that has been vetted by the industry as having like the best security in place for the exchange. But in my opinion, has a really shit interface. People seem to disagree with me on that, but I find it highly unintuitive. But anyway, they've been around a while.
They all are. If you're a crypto exchange, it's like in the bylaws that you have to make a crappy UI.
Yeah, exactly. Make it so that you can't actually use it.
Right.
So I can see Kraken using this opportunity to make a some kind of acquisition, which I know they've made a couple of strategic acquisitions recently, but I can really see them making a purchase. Maybe they even purchase Bitfinex. I don't know. And then I think that something like that needs to happen, because what we have is usually liquidity comes with trust over time, right? Or at least in my opinion, I think people flock to the exchanges that have been around the longest, that have the most trust, that have the most security. And so if you get the rise of a new exchange, it's not going to make that much of a difference. I mean, we've already seen that with, what is it, BitSquare, the decentralized exchange. I mean, there's not a lot of liquidity, and without liquidity, you can't really make trades, accurately. And so I think what needs to happen then is an established name needs to step up, and then not something like Coinbase, because the whole GDAX thing, like there's no liquidity on there because of other reasons, like the KYC and AML laws and that sort of thing. Not to mention, I think people are really turned off by them right now. So anyway, so I'm thinking that Kraken could make an acquisition soon. That's sort of my prediction.
So that's good. That's very interesting. Something I should have thought about is that rather than a new player emerging, consolidation is what engenders trust. So if you had a Kraken or a Bitstamp or whoever, an established kind of older player that that doesn't have a history of hacks, or if they do, they've handled them properly, like Bitstamp did. If those players start consolidating the exchange industry, then I think then you're right. Then that could be a definite solution, because I mean that's even happening in the legacy market exchanges,
like
in NYSE and ICE and Next, and I mean there's a ton of exchanges, even just in North America, that are all kind of consolidating. So that's encouraging, actually. I hope to start seeing some consolidation, some acquisitions. That would make me more bullish.
Yeah, I agree. I think that would be the best alternative to everything going on, just to find some security. That's really the most important thing, is security.
Yeah. All right. Yeah. Well, I agree. It's a waiting game until then. So, wherever you guys are trading out there, keep doing it, but be careful. That's all I'd say about that. And as far as Bitcoin price, I mean, until we break from this kind of 570 to 580 area, there's literally nothing to talk about. So we'll just keep watching Bitcoin flatline at 575. Goes 3x in about 2 or 3 weeks. So, I want to talk a little bit about that. Monero is, and kind of, what the hype is about. And so just first of all, technically Monero had been building a pretty big base over the past years with some spikes in there, but really bullish market structure and big accumulation down at, about between 10 and 20.001 at 0.002 Bitcoin. So that was kind of the setup. And, all the bulls we've always talked about how Monero's perfect for the dark markets. Bitcoin is okay at it, but Monero would really be good at it. And I think, the darknet market admins realizing that there's this continued push to de-anonymize Bitcoin, have realized that, there is another option here, and that is this other crypto coin called Monero. And so I think it was maybe like a week ago, mid last week, one of the two big darknet markets on the internet said that they were working to implement Monero transactions. And then I think it was the second biggest. And then the Alphabet, which is the biggest. They are the biggest. They came like a day or two later, and like, oh crap, those guys are doing Monero now. We got to do Monero too. So they announced that they were going to implement it on September 1st. And so again, I think these guys see that Monero, the devs are, have worked enough to where this could actually be, the coins could be used in real economic transactions. And so anyway, that caused just a massive spike from like 30 to 60 earlier this week, and I think maybe it was over the weekend. But anyway, it kept rallying through all kinds of resistance, all the way up to almost what are the all-time highs, around 0.01, before dropping back down to where it is now. But it's been a hell of a ride. We've been very happy about it because we've been bullish on it for about 2 years at BBA, and have been getting very long it for a long time. So I think this is good news. It's
it's accumulating on dips.
So we think continue to buy on dips is the way to go, because we don't necessarily think this is over yet. But it does highlight this kind of this contentiousness between Bitcoin not being private but wanting to get there, and then Monero actually having working anonymity as we speak right now. So I'm all for privacy, anonymity, fungibility. I think those things are great. I think Monero has great potential. Don't run out and put all your money in it, but I think it's a great complement to Bitcoin, at least in the meantime, while Bitcoin is trying to get its act together on these things. What do you think about the whole issue here? Yeah,
agreed. I've also been loving Monero for quite a while. I started looking at it in 2014 and accumulated some then. I actually don't hold it. I've just been trading it, but I accumulated a large amount at the bottom, or the bottom of this move, and been trading it since. But what's interesting to me is that these darknet markets, I think, if I had to bet, I think they've been looking for an alternative to Bitcoin. And Bitcoin, it works well enough. If I'm not mistaken, all the darknet problems of the past where people have gotten taken down, I don't think it's really resulted from any kind of Bitcoin blockchain analysis. It's really resulted from flaws in the Tor network. Does that sound accurate to you?
Or that or user error. Just like having bad OPSEC, just being stupid about covering your tracks. Either one of those two.
Right. So we haven't had a problem that's 100% related to blockchain analysis yet, which could happen. I mean, what was it? Bitfury just released a paper on the theoretical possibility of untangling CoinJoin transactions.
I saw that.
I thought it was a little overhyped. I don't think that they've nailed down a solution to that, or nailed down a process to that. I just think that they were trying to show hypothetically it's possible. So anyway, it sounds to me like the darknet markets have done their research. They didn't just go out and choose a privacy coin, because Dash, it has the marketing, it has the power behind it, like the people who are involved.
Market cap, much bigger market cap.
Yeah, bigger market cap. But this tells me by choosing Monero over Dash, something like Dash, they've done their homework. They saw Monero as having less vulnerabilities than Dash, and that to me is really important. I really respect that a lot too, because they took their time and did it right, in my opinion.
Yeah, I agree. I mean, theoretically, I feel like they could have considered Monero a year ago, but there were so many protocol level issues with all kind of the classic Bitcoin stuff, scalability and all that it really did make a lot of sense. But despite, contrary to what popular opinion is with Monero, sometimes the dev have made huge strides. And the whole misconception is that there's no GUI wallet, no official graphic interface user wallet, user wallet yet. So, that, say what you will about that. Yeah, probably maybe there should be one so far, but protocol level, kind of like one of the big problems with Monero was when you ran a Monero node before the Hydrogen Helix release, it used up a ton of RAM. Like you pretty much, if you were running a Monero node, you couldn't do anything else on your PC because it was sucking so much RAM. And so like issues like that, you don't want millions of transactions happening on a blockchain that nobody's going to secure because it's a pain in the ass.
Right.
You know, so I mean, I think that these guys were smart enough to know, or maybe they were even talking to the Monero devs. Who knows what happens behind the scenes? But waiting for a time when it would be appropriate to implement something like this. So good on all parties, in my opinion.
Yeah, agreed. Yeah, so that to me made the bullish case for Monero, and it makes sense too. You know, I know we've got a lot of fans in the Slack group of Monero, and rightfully so, but it really did deserve a little more attention than it was getting, based on the fundamentals, based on, you know, the privacy aspect. And I think we all kind of predicted it was only a matter of time before the darknet market started to implement Monero, which, so this was mentioned too. The fact that, let's say the darknet markets, they replace Bitcoin with Monero, or at least they do it in tandem with each other. They use it in tandem. So that takes pressure off of Bitcoin. It takes regulatory pressure off of Bitcoin. It takes a negative press away from Bitcoin that, you know, I think is good in the long run for Bitcoin. Nobody can, if no longer people can say, you know, oh, well, that Bitcoin thing's associated with drugs and child pornography and things like that. You know, we've leveled up, I think.
Yeah. Right. Yeah. So I think it could be bullish for Bitcoin as well. And that has been bandied around on our Slack. You know, well, if Monero really does gain traction with these criminal, you know, markets, then will that take some of the heat off Bitcoin? And I think it could. I think regardless, this fall Bitcoin rallies in price, but that would help some of that regulatory pressure come off. I think that would be even more bullish.
Agreed.
But yeah, I think so. As far as Monero goes, you know, I still am holding almost all of my long-term investment. You know, despite this huge run up here, I haven't sold that many at all. The ones I did were right around here. But I mean, after a run like this, you got to play for a consolidation, a pullback here. So we're looking for a little bit more downside before it tries to head back up. Just for anybody out there. And if you want the full forecast, all pro trade and everything, subscribe today. Do it.
Nice.
So anyway, so yeah, let's move on to the legacy markets, because there's a few interesting things going on there, despite the appearance of complete lack of interest in stocks and I mean, pretty much it's not just Bitcoin and crypto. This is the time of year when everything is boring. It's just, I mean, there's, you know, like a 10 point move in the S&P, which is nothing, is like a huge move during August. But there are some things under the radar that are very interesting that are going on that might be somewhat worrisome going into the later part of the year.
Yeah. So I just, there's a couple things I want to talk about. I'm not going to do any charts or Forex stuff like I have the last few shows. I actually want to talk about some fundamental things. Let me do a screen share here. All right. So first I was going to talk about LIBOR. So I brought it up in the Slack group, but I kind of wanted to just really emphasize how important.
I can see my screen on your screen.
All right, so I'll go through this chart here in just a second, or this spreadsheet. But basically, just want to real quick. So what is LIBOR? LIBOR is the London Interbank. It's an interest rate. Overnight. London Interbank overnight rate. Thank you. So it's used as an interest rate index for interbank borrowing. Okay, so it's sort of like the Fed funds rate, and it's usually within a few ticks of the Fed funds rate. They're typically not that far apart. And when it's in line, or when it tracks the Fed funds rate, banks are seen as as healthy. The collateral for the bank loans are safe. And so there's a general sense of safety amongst the banks when the LIBOR rate is in line with the Fed funds rate. But something happened during the subprime crisis. So during the subprime crisis, which was, you could see on this spreadsheet here, you know, you've got pretty closely matched Fed funds rates to LIBOR rate. But then as 2008 got deeper and deeper and the crisis started to really set in, these rates, the Fed funds rates went down, but the LIBOR rates stayed where they were, if not went up, right? So you've got, you know, zero Fed fund rate, you've got over 2% LIBOR rate.
Yeah, that's crazy.
So, yeah, exactly. And it's in those moments where banks are hoarding money, right? They don't want to loan out their money because that money is collateral for the debt obligations that they have. And they're afraid to loan it out without a high interest rate because of the risk that the underlying collateral could collapse, which would therefore cause the bank to collapse. Right. So,
right. Yeah, that makes sense.
Right. So over the past few years, the LIBOR rate came back down and had started, being relatively close to the Fed fund rate again.
All right, real quick, I just want to make something clear, just so our listeners are clear, like I am. So we know that left column with the zeros that's artificially set, right? So the Fed sets the rate of zero. What about LIBOR? There's not an organization that sets that, right?
No, it's a market set rate.
Gotcha.
So and that's why they can differ so much, because the Fed is trying to, they're trying to lower interest rates in order to increase the money supply. But if LIBOR isn't following the Fed funds rate, there's a reason, right? And that reason is typically because, like I said, that collateral may not be safe. There might be a high risk that the banks are holding. So they have to hold on to the cash. They can't loan it out because the loans they've already made out are unsafe.
Yeah.
Right? So the risk is there. All right. So we talked about the subprime crisis. So what's going on today then? Well, so let's look at this. So this is the LIBOR rate over the past, I guess, year. Yeah, since the beginning of the year. Yeah. So you can see it started slowly creeping up, it pulled back a bit, and then just went parabolic, right? And the Fed.
Sorry.
Yeah.
Classic.
And the Fed
pulled back there.
Yeah, exactly. It was beautiful. Yeah. But then it just shot to the moon. And so now there's some speculation among smart people, the smart people who pay attention to these things. Okay, what's going on? Are banks having trouble with their collateral again? Is this a bad thing? Or is this a sign that shit could be about to hit the fan?
All right.
So I can't profess to know the answer to that, but there are other reasons that the LIBOR rate could rise that don't necessarily relate it to risk or risk of collateral. I know that there are some new regulations around money market funds, and that's about as specific as I can get.
Okay.
but that I'd encourage anyone to do some research into that to try to understand it.
Yeah, I was going to say, if we could go back and do the data set kind of correlation analysis, say, when LIBOR over Fed funds spreads get to a certain threshold, like 90 or 100% of the time, it means there's a pullback in the U.S. stock market in the next 6 to 12 months. Something, if we could find that kind of relationship, that would be really helpful.
Yeah, I'd love to run a study like that. I'll have to look at it a little more deeply, but I'll see what I can do.
Yeah, we could just talk about it next time maybe, but that might be helpful for people if we go, hey, look, we're not to the threshold yet, but another 10 basis points here, and this is going to get ugly in the next 6 to 12 months. That would
be because what does it mean? Well, it literally means a credit contraction, right? Because if banks aren't loaning to other banks, banks have to pay a higher interest rate to get loans to cover their overnight rate, right? To cover their the amount of funds they have to hold each night is set by the Fed. Yeah. And other banks around the world. So they have to pay each other banks to borrow to cover those funds overnight. And if they can't borrow, well, then there's a credit crunch, and banks can easily collapse because of that.
Yeah, right. Gotcha. Yeah, that makes sense.
So I don't know what that threshold is, but if it keeps going,
if it keeps going up, it's a bad sign, right? So we can just, generally speaking, without even running statistics, we can say if that line keeps trending up, that gets progressively worse for the global economy.
Yeah, agreed. Exactly. Yeah. So
cool.
I'll keep an eye on
that makes sense. So caution is warranted. I would say, especially seasonality wise, this is the slow period, but October, kind of into September, October, beginning of November, that's the most volatile most bearish time of the year for the market. So if you have these kind of signals coming out of the summer, going into a seasonally weak period, there could be a big pullback in the stock market. Now, I'm not talking about, crash 50% or something, but a 10% correction. It's been a long time, and I think it's time for another one.
I agree. And I mean, who knows if this would contribute to that, or if it would contribute to a further crash or some sort of credit meltdown. But the point isn't to just produce FUD here. It's just to show you, okay, this is important. Keep an eye on it, and just keep that in mind in terms of risks with whatever investments you're making.
I totally agree. But also, these kind of indicators, these credit indicators, now have more weight than they did prior to kind of the age of central banks, because all growth is driven by debt now. It's driven by credit. So when credit and debt markets start deteriorating, the growth will disappear from the world completely.
Yes, absolutely. And that's how you have abrupt halts in the economy, in economic growth. Yeah. And not just halts, but pullbacks, big pullbacks.
Right.
And
where we go negative. Yeah.
Yeah, right. You cannot defeat the business cycle. You can prolong it, but I think whenever you prolong it, you're just suppressing the volatility. And whenever you suppress volatility, you get hyper volatility. So at some point, if we let the business cycle just play out the way it should, they would be, medium-sized corrections and medium-sized run-ups, and there would be no manias. There would, if we let it just express itself the way that it should, then we wouldn't have so many problems. But instead, we try to push it down. It's like holding a balloon under a 10 feet under a swimming pool, and it's just going to explode out at some point.
It does. Yeah. We've talked about on the show and in BBA multiple times the idea of range contraction and range expansion. Right. Absent the fact that whether the market, a given market is manipulated or not, the longer its range contraction is, the more violent and bigger the range expansion is going to be.
Right.
So, I mean, it's if you just, again, I know we're talking about credit and equity, it might be a little confusing, but if we just look at the U.S. stock market being pinned up here near all-time highs between 2175 and 2200, something like that.
Right.
That is after a big move, that is a range contraction. The longer that this range continues to elongate itself on the chart, the bigger the more magnitude you're going to get on the move out of it. And again, I think it's going to be to the downside, given that we haven't been able to break the new highs in about 2 weeks, although we're hovering up here. So, the same thing in the debt markets. You suppress volatility and contract ranges for so long, the moves are going to be violent. We haven't seen it yet, but we will one day.
And this tells me that this could be the market demanding that interest rates be changed. Interest rates come off that lower bound, and once that happens, the market takes control, and the Fed, the central banks lose control, which I'm fine with, but the consequences are going to be really hard.
Yeah, really, really hard. I can't help but think that holders of sound money will do better than anybody else. But
agreed.
Regardless, people out there, your family members aren't going to be buying Bitcoins and gold. So when all this goes down, help them out.
Yeah, exactly. Or just say I told you so and peace out.
yeah, be an asshole and just be like, yeah, right. I'll get you a beer for being so wrong.
Right. There's one other thing I want to talk about.
Yeah.
You were saying, it's interesting, you were saying the range expansion and contraction. So I always talk about the dollar and how the range on the dollar just expanded, just blew up 25%. And that I think it's been in a period of contraction for the past, year and a half. And which is pretty much where we are. I don't have a chart to show you in front of you, but
that's fine.
Just take my word for it. So I think that the longer this
so I just real quick. So if we are in a range contraction right now, is your bias still to the upside when a resolution comes?
Yeah, it is. It is, and this is why. Okay. Again, fundamentally, a shortage of dollars in the economy, right? And because of that $10 trillion carry trade, where so many people were borrowing dollars and investing in dollar-denominated debt throughout the world, and those dollars have to be paid back at some point, and which that drives the dollar price higher because they have to buy dollars to send it back, right, to pay it off.
Yeah.
All right. So here's another example of where this is playing out. So banks and speculators, when they have free dollars, like when they have just spare dollars lying around, what's going on in Japan right now is that banks and speculators are taking those dollars and they're doing what's called, it's a dollar yen basis swap. So what that means essentially is just that they're loaning out dollars in exchange for yen. Okay. And those dollars right now, those dollars are carrying a premium, which means when they loan them out, they're getting paid pretty handsomely to loan those dollars. But because banks and these speculators are pretty risk averse, what they're doing is they're buying JGBs with the yen. So they've loaned out their dollars, they receive yen, they're buying Japanese government bonds that are negative yielding. So right. You know what I mean? So what is that? How is that? What does that mean? Why are they doing that? They're losing money on an investment. But here's the thing. The dollars that they sell are at such a premium that even though they're investing in negative yielding bonds, they still are making a ton of money on the premium from the dollars, which tells me that the dollar shortage is real and it's massive.
No kidding. Okay, that's interesting.
Do you see what I mean? Because they're, even though that they're getting a negative return on the JGBs, they're still making money, and the spread is only widening. I mean, the negative yields in JGBs are only going deeper and deeper, and it's still happening. People are still doing this dollar yen basis swap. So that tells me
there will be a tipping point, though, right?
Yes, yeah, there will. And at some point, those dollar trades have to be paid back or defaulted on, which either scenario is going to be bad because it sends the dollar surging, and the credit can just really just blow up, especially in emerging markets, but even in places like Japan. So
why Japan? So I don't get, I get the loaning of dollars, and I get putting that money back into some kind of sovereign bond. I don't know why you put it in one of the most overvalued sovereign bonds. If I was a fund manager and I had all these yen, right? I guess maybe just because that's what it's easy to just go buy JGBs with yen. But I wouldn't be buying those or Swiss national notes or any of this hyper negative interest rate out there. But it's just me. I'm a gambler. I'd be buying like Venezuelan 10-year bonds and getting like a 50% annual interest rate or something like that. But anyway.
Yeah, but you could stomach risk. I mean, we're talking about banks. Right? Yeah. Banks are pretty low risk. But again, you have to focus on the dollar side. I mean, if I have yen, I'd rather be in dollars than yen, right? I'd rather be in what I perceive as a safer currency at this point.
But why not hold the yen? Okay, here, so how about this? Why not just hold the cash in yen rather than buying the JGBs? Is it safer really than cash? I mean, I don't think a government bond is safer than holding piles of yen, because you don't really hold piles of yen. It's just a number on a computer screen, right?
But I don't think it matters, right? Because if you're a bank and you're holding cash, you're still going to get that haircut, right? You're still paying a negative rate. I mean, that's the way that NERP works. Like it's a tax on holding cash. So you put it in.
Wouldn't you be double taxed then?
No, because you're in government debt. Because actually, government debt, there's an exception in Japan. So you're not double taxed. You're just taxed that negative rate of the JGB. Do you see what I mean? So either way, you're kind of screwed. So.
But if you're a bank, okay, we'll wrap this up real quick.
No, I'm curious about this too. I may not have an answer.
If you, if you're a bank and I get it. If you are taking money from the government, if you're taking like essentially the kind of the Fed's loans, if you're taking capital, then you would need to take the haircut. But if you're just, if they're just random investors out there who, they're doing this dollar yen swap on, is that, I mean, cash is not, cash is cash. I mean, it's taxed via inflation, but cash is always just cash. There's no rate on cash. It's just, you're just holding cash, and you either, you just go with the inflation rate. So and then I can see if it's kind of a double whammy if you're taking yen from essentially the BOJ and then buying JGBs with that that are yielding negative, then you have to pay that penalty every month or every 6 months or year, whatever it is. But I don't know. I'm a little confused as to how. I mean, I guess the money only gets into the system via debt. I mean, that's the whole key to the thing, right?
Yes.
Yeah. Okay. So I mean, so that's where where it gets doubled up. So you're right. You might as well just keep it in JGBs at that point.
Right. And so if I'm a bank and I put it in JGBs, it's an investment, which there's the potential for the JGB price to continue to rise too, right? So there's at least a possibility of return on that initial investment. Whereas if I'm holding cash, I'm going to get a haircut and that's it. Right?
Yeah.
You see what I mean? Because the yields can go much lower. I think that they can still go lower. I wrote about this. That I don't know that this is a bubble that will burst anytime soon. I mean, yeah, they're overvalued, but relative to what? I mean, the rest of the world.
Right.
We're talking. Go ahead.
I was just going to say, so this is all making me think. I've thought this for some time. It's kind of talking through this and solidifying it a little bit. I think you're right in that this stuff is so complex for just the average person to understand fully and realize the implications of. And that's the only way that this charade is going to end, is when people demand that it ends. And so I agree with you that this could go on for a long time, not because these central planners are such geniuses, but because this is hard stuff and populations are pretty stupid, to be honest. So, I mean, that's where I agree with you for sure.
Yeah. And they're people have anxiety and they're quick to believe anyone that sounds confident about what they're saying, because it helps alleviate anxiety. So if I have anxiety and the central bank tells me not to have anxiety, I'm going to feel better if I'm a moron. You know what I mean?
Right. Especially if the markets go up, if they say, oh, everything's going to be fine. And then, hey, look, the markets are up. All right. Yeah, everything's fine.
Yeah, exactly. Yeah.
Bummer.
So it's something I'm going to keep an eye on. Yeah, I believe so. But I'll keep an eye on this, and maybe I'll try to whip up some research on the the LIBOR versus the Fed funds rate and the spreads there.
Cool. Yeah, that'd be great. I think that'd be informative for next time. And speaking of next time, we won't wait a month before doing one of these again. I think maybe if we get on a morning schedule like this, like we are today, then that might actually be easier for both of us.
Yeah, agreed.
Cool.
All right, man. Well, that's all I got.
Awesome.
Great show.
Yeah, it was great to catch up with you and talk a little bit. Hopefully we'll have more to talk about on the Bitcoin kind of crypto side next time. But great talking to you, and hopefully you have a good weekend, and we'll touch base again in a couple of weeks.
Thanks, man. You too. All right, take care.
All right, everybody out there. Thanks for listening. Check out bullbearanalytics.com, and we'll talk to you next time.